Okay. Good afternoon. You are all very, very welcome. My name is Mark Spence, Chief Executive of Construction Employers Federation. It's my absolute pleasure to be in Newry today at the offices of our patrons, FPM. And you're now going to receive a succession planning advice webinar from Managing Partner Feargal McCormack. Absolutely delighted to be here. Feargal, thank you very much for agreeing to do this morning. It's an important matter for construction companies, particularly in Northern Ireland. Obviously, a lot of family businesses, SME businesses. Some of you are in your second generation, some of you are planning for that second generation, and a lot of complex issues to be taken into account in those decisions for safeguarding the value which you've accrued in your businesses. So we're going to do the webinar this morning. Feargal has a presentation for you, but we're very keen for you to raise questions. And if you're familiar with Zoom, you know what to do. If you're not, if you look at the bottom of your screen, you will see there is a Q&A function. Q&A allows you to upload questions which only Feargal and I can see. And then we can address those questions, or you can put something into chat which everyone can see, whatever you feel comfortable with. But what I would say is there's probably no question you're asking or thinking about that nobody else has also thought about. But obviously, everything will be dealt with very, very high level and not specific to your own circumstances. So with no further ado, Feargal, delighted to hand over to you and look forward to the discussion ahead.
Mark, thank you very much indeed. And I'm very honoured at this opportunity to talk to the Construction Employers Federation this afternoon on succession planning for family businesses. I'm very conscious it's actually very important for the construction sector. It's fair to say that I plan to use my slides as an aide-memoire. I won't necessarily cover every slide, but if anybody likes the slide afterwards, that's not an issue, Mark. We can make them available. And equally, I do encourage questions. And Mark, if I get caught away and hung away and don't spot the questions, please feel free to disturb me and fire the questions. A bit of interaction never does anyone any harm.
I'll do that for you,
I think set in the context for the presentation, it's fair to say that inadequate continuity and succession planning is one of the main reasons why so few family businesses actually survive. And it's widely acknowledged that the best way to sustain a successful and enduring enterprise is to implement an integrated plan which will pass down assets, develop capabilities, and transfer responsibilities and roles. And the transfer of power from one generation to the next is often one of the most emotionally fascinating challenges facing family businesses. And the importance of getting this decision right cannot be overstated, as the actions taken by each generation can and will shape the family and businesses for decades to come. So at a high level, in terms of succession, very simply, there are probably four key issues that current business owners need to address. Whether they think it's better to sell the business, divide it up, transfer it in whole to the next generation, or in part, or bring in non-family professional management to run the business, retaining ownership in the broader family. Now, it's also fair to say that construction businesses do cause a particular challenge in terms of succession, and that in particular, trade sales of construction businesses, because of the tender framework that many of you operate in, makes the process a little bit more challenging if you're selling the business or passing it on to third parties. Suffice to say that I've been fortunate over the years to work with quite a few. Actually, quite a few might be an understatement. I think I've done about 175 succession plans, and in the last 10 years, probably 2/3 of my time is spent in this area. And it's equally fair to say that there is a new business landscape evolving, and we're seeing, as you are, different changes in market and customer behaviours. And as a result, there is a focus now on re-engineering, which may involve resizing our business model going forward and having a robust risk strategy, which succession definitely should form part of, as should wealth modelling for your own lifetime roadmap in terms of the owners. And really what we're saying here is the 3 R's: reflect clearer, respond smarter, and rebound faster. And it's fair to say that FPM, within the AB group, we do have considerable experience in dealing with family succession. And one of the key things that is really arising now is the need for family businesses to be very focused on de-risking and maximizing family wealth through planning a succession and implementing governance framework and policies. Now, where you see that COVID definitely brought to a head, because all of a sudden we realised, thankfully, it didn't happen, but that the ass could have fallen out of our business. And if we'd left everything in the one egg nest, that would have had very significant implications for the wealth of our family. So during the course of this webinar, we hope to discover the peace of mind knowing your family. You can discover the peace of mind knowing your family's wealth is protected and preserved for the benefit of future generations. Now, what we hope to achieve basically very quickly is an understanding of the dynamics of family business, which quite often when you get involved in one that's gone wrong, I'll be honest with you, this is quite often the problem. At the very basic level, the dynamics of family business haven't been understood. An understanding of how you begin the succession process and the need to get the family business ready for succession. As many of you will know, because I know some of the people on the call, maybe have forgotten what I need to know, but you've got to get the business, of the truth is told, virtually ready for sale, even though you may never sell it, to make the most successful family business. A recognition, this is really important, and sometimes this is why this presentation is not a textbook presentation. This is live case studies, and I can assure you, you won't see a lot of this in textbooks. But we believe, in our experience, the best way quite often to treat children fairly is combining personal and business assets, which is a very important distinction. I think one has to acknowledge the things you need to address in the business continuity and succession process, and a recognition of what the factors are, and we'll come to those at the very end, that are most likely to cause you problems. I haven't done the presentation. And ultimately, most importantly, to acknowledge that no two successions are the same, but through an emphasis, and I stress this, on hearts and minds issues, any business continuity succession challenge can be successful. And what I'm really saying here, and I'm saying it very bluntly from an accountant, if you put tax at the center of your family succession, it rarely will work. It has to be hearts and minds, with tax then giving the most effective tax impact of what you've decided to do. That's a really, really important point. And it's fair to say that if we look at the facts, only 30% of family businesses survive the second generation, and only 3% survive the fourth. And the reason is, as we'll highlight very shortly, there are unique dynamics of family businesses which make them different from non-family businesses. And it's fair to acknowledge that family construction businesses, they face complex issues that affect not only the destiny of the business itself, but also that of the proprietor, their family, and their employees. And it's fair to say the key question is, how does the proprietor reconcile his or her own and their family's aspirations with the commercial goals of the business and its long-term sustainability? And the reality is, it's often the case, sadly, and you'll all know case studies that's looking around you, that emotion blurs the vision of family business leaders. And equally important, I have to tell you, the good news is that empirical evidence quite clearly shows that family-owned businesses, believe it or not, outperform public companies over time. And the reason for that is they may be more conservative in a boom, but they do better in a downturn. So that's empirical evidence available. And it's also fair to say that that the overriding characteristic that distinguishes most family businesses is the unique atmosphere that creates a sense of belonging and enhanced common purpose among the workforce. And you see this in many manifested, this intangible benefit in many different ways, whether it be in commitment, knowledge, flexibility in time, working money. You're not looking at your watch, you're working day and night, you're inheriting a business and it's in your blood. Long range thinking, you don't need to take money out tonight. You're willing to leave money in the business. Stable culture, speedy decision making, which unfortunately sometimes can have the opposite effect, and reliability and pride. Without doubt, those are the core factors. But in the same way that family businesses' strengths are not unique to family businesses, neither are their weaknesses. But family businesses are particularly vulnerable to specific failings. And it's fair that many of those problems hinge on the inherent conflicts that can arise between family and business values, e.g., giving people responsibilities and jobs based on family blood rather than their suitability or their ability to do the job. It's also fair to say that the older generation may be resistant to change. They may think nobody can do it as well as them. There can be a lack of structure and ad hoc management style. We've already covered the emotional issues. Lack of financial resources to fund succession. Believe it or not, that's a very important point. Tragedy, you'd be shocked how often succession is imminent And all of a sudden, people didn't realize that they hadn't put in place the right strategies for the previous 10 years to ensure there was adequate funding. And we'll come to that later on to fund the succession. A lack of a formal business strategy, and to be honest, in some cases, leadership and legitimacy. Now, if there's one or two takeaways I wish everyone who's on the webinar to take, this is one of them. This is what's called the three-circle model for family businesses. And believe it or not, it identifies the dynamic of a family business and the needs of different stakeholders. Now, I'm open to correction, but to put it bluntly, I'm convinced there are only 7 stakeholders involved in any family business. But it's really important that people running a family business and people in a family recognize these characters. Because depending which stakeholder you are, you will have a different priority for the family business. So, for example, stakeholder number 1 here, he or she, they're a member of the family, they don't work in the business, and they have no equity in the business. Stakeholder number 2 is a silent, non-family member, silent investor in the business. They have equity in the business, but they don't work in the business. Stakeholder number 3 is an employee in the business. They're not a member of the family, and they have no equity in the business. Stakeholder number 4 is where you start to get a bit interesting. They're a member of the family. They have equity in the business, but they don't work in the business. They're maybe in Australia or all over the place. Stakeholder number 5 is actually a non-family member who has equity in the business and works in the business. Stakeholder number 6, if you look at it here, is a member of the family who works in the business, but has no equity in the business. And stakeholder number 7 is the character who is a member of the family, works in the business, and has equity in the business. Now, the reason why I'm taking a bit of time there is, in your own time, think about it. Every one of those stakeholders will have different priorities. The person who's not working in the business, what good is it owning something in the business? You're going to get a mortgage, you're living in England or Australia or Europe. If you're getting no dividends, where's your money? So you have a different priority than number 7. Stakeholder 7 will say, let's take no dividends here. Let's keep reinvesting the money. I can see the vision. I can see the future of this business. So really important that you understand those dynamics. And it's also fair to say that our present circumstances do not determine where we go. They merely determine where we start. And the second big takeaway that I want to leave this webinar is this. There's a really fundamental point. If you look after the business will look after family through generations. Please think about that. We all can quote examples where family businesses have been wrecked because the next generation couldn't handle it. You're far better looking after the business and then finding a way to distribute the wealth of that business among family members. But the most important thing is to get the right people running the business, because if you don't, ultimately, the wealth of the individual family and its broader family suffers greatly. And I suppose what we're really saying is that business thrives when both effectiveness and efficiency are aligned and complement each other. What do we mean by that? Well, look, by effectiveness, we mean doing the right thing, strategic, working on the business. And by efficiency, we mean doing things right, which is operational, and tactics, obviously, working in the business. Now, basically, we have concluded within FPM that if you take the skins off most businesses, ultimately, size or otherwise, they're quite similar. And we've identified over many years, this has been adopted at different times. From our research, we believe there are 7 important factors in developing and running a successful business, which ultimately is key to the succession of the business, because a good business, remember, greatly enhances succession. Leadership and shared responsibility. All members of your team, it might be coming from a boring accountant, maybe a bad thing to say, but they have to be proactive with the selling process and customer focused and sales driven. Otherwise, you don't have a business. You've got to embrace the digital revolution, and IA obviously is coming in as well. Your competitive edge, what is it? Why us? Why our business? Cost and control, working capital management, we're not going to go into that today. Managing change and changing circumstances. You couldn't be doing business currently without acknowledging the increasing importance, and we'll touch on this slightly later, ESG, obviously equality, diversity, and inclusion, R&D, innovate or evaporate, and obviously Brexit and the Windsor Framework. And finally, people management. What do we mean by people management? Well, to be honest with you, and certainly in our own case, we say our employee brand is far more important than our business brand. And the reason that is that, to be honest with you, in my view, your employers are either your ambassadors or your assassins. And therefore, you have to ask yourself three simple questions every time. If you're taking on a new employee or if you're doing an annual appraisal, do they get it? Do they want it? And do they have the capacity to do the job? And you can see that's called the GWC. So in terms of leadership in the corporate setting, obviously it's centered on the ability to deliver change. Ethics should be centered at the center of all organizations. Now, we would argue that for 10 years ago, I would have been saying here, can I do it? Yes, we can, Bob the Builder. Unfortunately, it's not Bob the Builder anymore. It's actually focusing on ethics. Should I do it? And the tragedy is you won't know probably 3 years later, but it's a really important culture to have in a business at leadership level. We've obviously got to treat people, as we've said before, with dignity and respect diversity. And finally, we must future-proof the sustainability of our business, because no good passing on, excuse the language, of shit business, by working smarter and satisfying today's needs without endangering future generations. Now, I'm not going to go into ESG today, but suffice to say, and obviously it is ESG and not just E, but sustainability is now becoming so important. And certainly in our own organization, we have a specialist team headed up by Adrian McShane, and more than willing, if anybody wants to flush that out at a later stage, but ESG needs to be in there. And obviously, above all, I think humility. How can we do things better? And I'm moving on because I want to really get focused very quick on the core of the subject, but I think before we do that, we have to accept that business culture is the glue that joins everything together. And it's sometimes described, you think about it, as how we do things when no one's around. And authentic leaders have to create that safe place of belonging with a purpose that creates an environment of care, energy, creativity, quality, and collaboration. Now, in terms of family members, you need to then look at the working and the non-working family members. And again, we've touched on some of this in the dynamics, but one of the things is really, really important is what is the remuneration of family members working in the business, and what is the remuneration for non-family members? And again, that has to be open and thought out for the good of the business and for the good of the family. In terms of non-family members, think of somebody who's been with you for years, maybe a senior manager, and you're bringing in a son or a daughter all of a sudden. We know you wouldn't do that, but if you did do that, it's stupid. You've got to really be very careful to keep all your employees informed. Trust and fair treatment in the family, but fair treatment also for your employees. And there's some fantastic examples of successful family business successions. And within that, the level of loyalty and commitment then is phenomenal. One of the really key points is to make at a very early stage. If you're working in a family business and you don't have a director or an employee contract, that's a major weakness. You must have separate ownership, which is the shares of the business, if it's a limited company, from management or employment. Equally, in terms of management or employment, you must have defined responsibilities like anybody else. You must be paid for the job you do with bonuses, etc. Ultimately, the owners get dividend, but you must make sure, it's back to that point I said earlier on, you got to make sure the business is run well, and you got to motivate everybody who's working in the business to maximize profits ultimately for the owners. And again, the slides are available on request. But it's also fair to say we all recognize that change is difficult to implement because people by their nature are often resistant to change, and when they will quite often impede new ways of doing things. However, I think all of us now know that you can't do today's jobs with yesterday's methods or mindset. And we have a simple option. We either innovate or we evaporate. And it's fair to say, and I've listed these, but I don't plan to go into each of these. I've given examples of what we would consider good business practice. And the reason I keep stressing this is, in our experience, without doubt, the businesses that focus on this first of all, to try and get these in place, make it a lot easier to subsequently do succession. Like, it makes common sense to say there's role and clarity in people's roles. You'd be quite surprised. You meet two brothers or two sisters working in a business, and you say, what's your role? You need to put the two of them in the same room at one time, because I can tell you get two different answers quite often. And again, all common sense stuff. So what are the hidden costs of family business? This is really an important point. For example, if you're operating out of premises that the family owns and you haven't, in your own management information, created notional rent, well, if you're not making super profits above benchmark, then you're inefficient. Because actually, if you think about it, you're getting the property free. I mean, that's madness. You'd be surprised how many people don't understand the importance of making notional changes for those type of things. Equally, if you're running a business and you're working 80 hours a week or 70 hours a week and you have no income protection, no life protection, no pensions, but again, you should be making a fortune because if you're comparing yourself with smart businesses, they're all incurring those costs. So it's again, you have to understand the hidden costs of the business. And again, I've given other examples there on the site. And it's fair to say that then, what are the barriers and obstacles we're observing out there in the market that you need to overcome? One, reluctance to change. Two, reluctance to the involvement of outsiders. Three, interpersonal relationships. Four, afraid to delegate responsibility. Just think about this. If you cannot delegate, you are a nuisance. A one-man business or a one-woman business isn't worth a dollar. You have to create scalability unless you want to be a person. Charge plenty and know that the day you retire, there's no good one. Lack of funding and finance, lack of financial information, poor management information, tax considerations, and inadequate challenge, the comfort zone. The young lad or the young girl driving around that flashy BMW, that's all important, not running the business. So sometimes we cannot control the events around us, but we do have the ability to choose our response. And it's our response which will ultimately determine our future success and our differentiation in the marketplace. And therefore, I suppose what we're saying, the old saying, persistence beats resistance. And now to get right into the core of continuity and succession planning for construction family businesses. Key challenges. You want to be able to control events. You don't want events to control you. Can I assure you, there's nothing worse than me getting a phone call. I've got them. I've got a wee bit of bad news. Will you come and see me? Or even worse, Daddy or Mummy died this morning. Plan early for succession. Get the business ready for succession. See, and that's why I spent so much time on that good leadership and business practices. Recognize that succession is a process and not an event. Certainly understand the legal entity of your business. You'd be surprised the number of people don't pick that up. Is it a sole trader, a partnership, LLP, or limited company? And that's very important, by the way, if you're comparing different types of businesses. Ensure the management structures are adequate in place. And then obviously that the business is sound. Now, we would strongly recommend you take advantage of a succession facilitator. I've been doing this now for 30 years. It makes a lot of difference to an outsider in the room. And an outsider, particularly talking to the senior generation at the start. Pick the right people for the job, not because they're family. Develop a business succession strategy. Obviously, embrace ESG within that. And transition should be over the long term. Picking up tax efficiencies, such as pension contributions and smart future capital gains tax and estate planning. And we'll cover some of those things short in case. So, what are we saying? We're saying we've got to avoid emotional and family strains by not fudging the decision. Please, please, please do not defer the decision to the next generation. It's a disaster. I can tell you now, I have never seen it work. It is an absolute disaster. The best people to sort out succession is the senior generation when they're in good health. And it's fair to say within that context, the owner should consider their preferred future role in, say, 1, 5, or 10 years, working in, managing the business, or somewhere else. Then have the courage to take the decision to the family business succession now and communicate that decision in an open and transparent way to family members. And you'll see how we suggest you do that through ultimately a family agreement. And then ensure responsibilities are defined and then appoint a clear leader. Anybody who's involved in not-for-profit organizations will know you don't leave it to a committee. So what are the business succession options? Well, there's probably 6. I said 4 at the start, but the truth is you can flush it out to 6. You transfer to a family member or family members. You operate at what's called an earn-in arrangement, where a junior partner or minority shareholder buys out the owner over a period of time through cash equity, allowing a transition of ownership. You appoint a professional manager. You liquidate the business, which is probably the most expensive, unless it's a voluntary liquidation, which suits in 1 or 2 arrangements, a voluntary arrangement. I go into that sometimes ask the question, but it's a very rare case, right? Or you sell and hold on part and wait for it, because this isn't, we see examples of these in the construction sector. You facilitate it via a management buyout, a management buy-in, or what's called a bimbo, which in reality is a combination of both. And that we have found has been suitable for some construction companies. And finally, you do nothing, and you're gonna laugh. I bet you're gonna hear now. Believe it or not, 67% of businesses do nothing. Empirical evidence. So what we're really saying is each of those succession options on the last page, it really depends on a number of things: the nature of the business activity, the availability of potential family and non-family members, the general commercial and business environment, the time of the succession, personal and corporate tax consequences, and the health and size of the business. Now, if you're thinking of selling the business, which there's nothing wrong with, by the way, because cash can be king, and an easier one to sort out with family. You have to understand what are normally the reasons we come across for somebody wanting to sell a business. 1, lack of successors. 2, non-core business. 3, family considerations, avoiding conflict. 4, business issues, as I've highlighted there before. Maybe you have an offer from a competitor. Maybe you think there's going to be imminent market changes or it requires major investment. You're just at your stage in life not up for it. You want to let somebody else take that on. To facilitate retirement. Key issues remain the same, however, whether you're selling to a third party or passing on the business to the next generation. That's a really important point. And I again make no apology for repeating reason 7, which is fundamental. Having a business ready for sale is perhaps the best way for the business to be at its competitive best. And we would argue that time and time again. You may never sell a business, but get it ready for sale. And as I've said before, there are specific challenges in the trade sale or construction companies. So therefore, you're grooming the business for sale or succession. You're preparing it, you're getting the management team in place, etc. You're identifying surplus assets, you're offloading them, and you're looking at any contingent liabilities or claims, and you're looking for any potential warranties that may be involved. So, how do we fund succession? Certainly, you don't fund it the 6 months before you think. You have to have thought this over a period of time. And the key considerations really are that financial security is important to a successful retirement plan success for the family business owner. I can honestly say in probably over 75% of all cases of succession I've been involved in, many owners, the mums and dads or the senior generation, they neglect their personal finances and wealth management. People who own successful businesses often tend to believe that their business itself represents their personal nest egg, and it will guarantee them financial security when the time comes for them to step down. Personally, I believe this could be a major mistake due to unforeseen circumstances. And I admit that COVID has certainly strengthened that perspective in my mind. So the truth is, from an effective financial planning perspective and funding of succession, there are 2 key considerations for peace of mind and a successful retirement and transfer of business. 2 schools of thought. One is you take ongoing cash withdrawal, or the second is you build up the balance sheet and you restructure at the time of succession or sale. The truth is you need a combination of 2, but probably up until 5 years ago, the emphasis may have been on the second rather than the first, whereas without doubt, the emphasis should be on ongoing cash withdrawal. You should not put all your eggs into the one basket. It's disastrous wealth planning. It's far too risky. You need to ring-fence different elements of your wealth portfolio for your family and for future generations. So, the tax issue. I picked a few case studies basically shortly to highlight that family business succession primarily brings, and obviously you could do webinars on this on its own per hour. So I'm just doing a high level review here, but it basically primarily affects two separate capital taxes. One, capital gains tax, and the other, inheritance tax. Now, in terms of capital gains tax, it's fair to say that family businesses are generally capital gains tax friendly. The exception is non-trading family businesses. And trading companies benefit from what's called business asset disposal relief. That replaced entrepreneurs relief. And what that says is the first 10% tax on the first, 10% tax on the first million of proceeds, and the balance of 20%. And there's also the ability to transfer your shares and avoid capital gains tax by enacting what was called a holding over relief. I've given you the relevant section there. I'm sure you'll not be quoting that overnight, but it's there. And the ability to place some or all of your shares into trust to avoid capital gains tax and inheritance tax on transfer. And we'll cover that in case studies later on. It's fair to say it's important to appreciate that capital gains tax applies only to the lifetime transfer of business assets. And that includes, obviously, family company assets. The transfers on death are exempt from capital gains tax, as death is not an event for capital gains tax. Death also, this is a very significant point which is sometimes overlooked, it also rebases all the assets to the market value at the date of death. So for example, if you could say that your family business was worth 500,000 10 years ago, even maybe less, you started off from scratch, and it's now worth 10 million. The market value, if you're doing a holdover relief, it'll be the naught, virtually worth nothing, the gain to 10 million. However, if you leave the shares to death, the market value changes, the base cost changes to the value at death. So all of a sudden, the base cost is 10 million and not naught, so there's no gain if the market value is 10 million. One of the dilemmas we all face, and there's no doubt this is a big dilemma, and we will come back to it very short in terms of case studies, is whether you transfer shares in lifetime or in death. And again, you'll see, we believe that perhaps the ideal solution is a combination again of both, for other reasons other than just there is the hybrid option where you place some or all of the shares in a discretionary trust. And there are very good reasons for that, because capital gains tax is avoided and inheritance tax can be avoided, subject to you survive in 7 years when you do it. The trust then ownership avoids an impact on the business in the event that the next generation beneficiary encounters an adverse lifetime effect. Again, we'll quickly cover that in the case study, but the point I want to stress here is trusts by their nature are complex, and certainly don't rush into a trust without taking a lot of very detailed advice. So, inheritance tax then. Families' businesses generally can be passed on free after their trading businesses from inheritance due to the availability of a business property relief, BPR. Now, it's important to appreciate that BPR provides 100% exemption for inheritance tax on the death of qualifying companies, and that would broadly be trading companies. One other thing to note is if your business property is outside the business but is used for your company, you can potentially qualify for 50% exemption from inheritance tax. However, the big tax blind point is transfer your business property into the business and then benefit from 100% inheritance tax relief, or as we'll see later, another option would be to do smart planning REIT, perhaps a director's SAS. So what we're really saying here is construction family businesses that are trading can be passed on to the next generation free from capital gains tax and inheritance tax in some circumstances, but certainly with smart planning, both inheritance tax and capital gains tax can be significantly reduced. Now, we're in an election year. A Labour government may be looking at president, the most likely. That may have impact. And all the rumours in the financial press is that they're very keen to reduce some of the benefits that are currently there in terms of the capital gains tax and inheritance tax. So, now is the time, the truth is told, look at this very urgent. So let's look at Bob, or Robert. Robert established Plant Limited in 1968. By 2023, the company's valued at 10 million. He's age 75. He transfers the business to his son, Jimmy, and he avoids capital gains tax via holdover relief. That's where you hold over that basically you acquired the business the same day as Robert originally acquired, the son does. In 2026, the business is still worth 10 million. Robert dies, and Jimmy sells the company to Jones Limited for 10 million after Robert's death. Jimmy's a bachelor. Unfortunately, he dies in 2030, leaving 8.1 million. I don't want to go into this in detail, be honest with you, because it's time consuming, but the slides will be available. But actually, very simply, no capital gains tax in 2023 and holdover. Robert dies within 7 years, so that's potentially exempt transfer. He hits a problem there because if you die within 7 years, you can have a problem there. Jimmy pays 1.9 million capital gains tax. You can see how he pays that. And the inheritance tax is 3.11 on Jimmy's estate. The total tax leakage in that situation is over 5 million. So 50% is the real tax. Very expensive. If you take example scenario 2, Robert still holds the shares of Plant Limited until death in 2026. Jimmy inherits the shares from Robert's will. Jimmy then sells the company in 2026 to Jones Limited for 10 million. And Jimmy dies in 2030 worth 10 million and leaves the estate to his nephew. Let's think over there. In 2026, no inheritance tax because he qualifies for business property relief. no capital gains tax, and the share value, rather than being nil, are rebased to 10 million. Very significant. No capital gains tax as no gain, 10 million cost against 10 million proceeds. And in 2030, Jimmy dies, and basically he has to pay inheritance tax, which works out at 3.87 million. So in reality, the total tax leakage is 3.87 million, 38.7 million, 38.7%. If we then look very quickly at scenario 3, Robert establishes discretionary trust. He settled the shares into the trust in 2023, holding the gain over. Trust beneficiaries are his son Jimmy and his grandnephew. Robert dies in 2026. The trust sells the shares in 28 for 10 million. Jimmy dies in 2030. You can see, and I'm not going through it, but the reality is in this case, the tax leakage is only 2 million and 8 million retains in the trust. So you can see a massive difference in terms of simply smart tax planning. So let's get back to the core area of business succession. Some common misconceptions. The oldest child should take over as managing director. Not always the case, and should never be assumed. All children should have equal shareholdings in the company, even if no involvement with the company. Often active and passive shareholders have very different objectives, and this can cause conflict. And the business cannot run successfully without the founder. I have to be careful in case of too many ladies in the. But again, in my view, that's bullshit. With proper structures and systems in place, the next generation can succeed. Just give them a chance. So, how do we actually now? We're here. How do we make it happen? Well, the first thing we're going to say is you've got to align your personal and your business goals. And the most successful family business transitions are those that result from establishing a partnership with the next generation based on mutual responsibility, respect, and commitment, rather than a unilateral decision by the owner, or suddenly did not tell them and leave it as well. What a disaster. So the main elements in a successful family transition partnership are below. Start planning early. The next one is massive. You won't see this in textbook. You prepare a statement of affairs for the senior generation for both their business and their non-business assets. Really, really important. You'll see later in a case study why that's important. You encourage, obviously, intergenerational teamwork. You develop a written succession plan. We believe this is fundamental. That's the family agreement. I've done close to 200 family agreements over the last 30 years. I'm not aware of them not working once. We talked about taking the advantage succession facilitator. And this is really important. You want to treat all the children fairly. And more importantly, you want all the children to believe they've been treated fairly. And that's where the family agreement comes into its own, because ultimately, of their own independent free will, they're invited to sign the family agreement at a point in time. You've obviously embraced the future, look at key management, establish a training process, plan for retirement, and decide on the retirement date. And again, in our experience, you're better doing that and sticking to it. So, what is this family agreement we're talking about, the succession plan? Well, first of all, it's important to highlight it's not a legal or a binding document. It's a document among blood members of the family. It does facilitate financial independence of the senior generation. We would suggest that to retain control of the family, unfortunately, quite a few of the next generation have divorces and various other things. To retain control of the family, the senior generation until second death, that achieves maximum tax efficiency. Very important, but this is where the family agreement comes in, because you tell your children what you're going to do, what your will is going to say, but the truth is, you don't actually transfer the shares. Then you go to what's called legal documents, which would be shareholders' agreements or partnership agreements, and they would have conditions of valuation. Again, we would argue there should be a definition of a good leaver and a bad leaver. In very simple terms, we would argue a good leaver is one of three things. You die, you retire within agreed ages, or you get a critical illness, a defined critical illness. Everything else is a bad leaver. Somebody wants to go and start on his own. Somebody, the wife or the husband, gets divorced. Everything is a bad leaver. That's really significant, because we believe a bad leaver valuation should be defined in the partnership or the shareholders agreement. Goodwill should be nil. It should be net assets. And then for a good leaver, goodwill, the value should be net assets plus a multiple of EBITDA. And that would be the goodwill for the good leaver. Again, we would strongly suggest that you put in shareholders agreements or partnership agreements, you put in restrictions in share transfers. For example, the first option should be the company can purchase its own shares. The second option should be pro rata, the existing shareholders. The third option should be any one of the existing shareholders. The fourth option should be to a third party agreed by the specified majority as per the partnership agreement of the shareholders group. Why do we say all those? We put all those in to protect the family wealth and sustainability of the business by saying Joe Bloggs can't just walk to somebody in the pub tonight and sell his shares. He can't, because the shareholders agreement prevents it. Really fundamental. And you can't do that whenever friction starts to arise. It must be in place. But the courts, in our experience, will always honour them if they were concluded in good times and everybody knew what they were signing. And then basically what we do now, to be honest with you, we do quite often introduce a second generation of small minority shareholders or partners. And the reason we do that is we want to buy them into the shareholders agreement or the partnership agreement from day one. And then we get around the fact that mommy and daddy may not even be involved in the business anymore by using designated majority decisions, which mean in order to get that young person or one or two of the young people to be involved in the decision, you could say that a specified majority in some cases could be 91%, depending on the exact chemistry of the shareholder. And again, we highlight then no discount for minority shareholders. The truth is, we normally like people to have a minimum of 5% because that makes them eligible for that business asset property relief, the 10% tax we referred to earlier. It's also fair to acknowledge that death doesn't respect age. And that's really important. And quite often people don't realise that. You've got to plan if the children die before the senior generation. And tragically, I've been involved, I think, in 4 cases. That has been the case. In each of those cases, the family agreement held up and worked. You've also got to acknowledge that there are children with special needs that may require, or adults with special needs, that may require special planning in terms of the family agreement. Again, compared to 20 years ago, the big issue is people dying. It's not people dying now anymore. The big issue is that people perhaps not having their full mental capacity. And therefore, we believe that anyone in business, anyone with any significant assets, should appoint a power of lasting attorney. Wills most likely will have to be changed after a family agreement. And we would argue that you've got to minimize the opportunities for disputes. And this is really important. I've seen a shareholders agreement recently that was desperate. I may as well be honest with you. Desperate. They had a deadlock provision in it, which actually meant that if you disagreed with anything, you could implement the deadlock procedures. Now, in our view, in FPM, the deadlock provision only takes effect for something that is not already specifically covered in the shareholders agreement with the partnership. That's a fundamental point. Really, really important practical point. I've come across that a few times. I can say it's a nightmare to resolve. And obviously, we talked with tax and partnership balance. So, very simple terms, there is the outlining of family agreement. Basically, what we do is that document is developed, evolves over time with meetings with the senior generation. Then, when we think they have got to the stage that they're ready to actually share that document with the second generation of children, only blood people, no spouses, only blood relatives in the room, normally at 5 o'clock in the evening, normally not at home, a third party place. A meeting is called, succession facilitator talks through the document, what mommy and daddy, if mommy and daddy are still living, or either one of them, what they plan to do with succession, how they think it's fair, etc., etc. Open discussion with all the family members. And believe it or not, sometimes it's been 7 a.m. the following morning, thankfully only twice. You eventually hopefully come up with a family agreement. No asking for assistance from a third party. You can adjourn into different rooms every now and again, but the family take the decision. And once you get that family agreement, non-legal effect, it's massive, because thereafter then you implement the agreed action plans, which quite often gives rise to legal documents. So let's look at our case study. Again, you'll appreciate this is complex, so just stay with me for a second, but it's being used to highlight a few key points. This was XYZ Construction Limited, turnover 10 million, EBIT 900,000, profit before tax 500,000, net assets 2.6 million, including property valued at 800,000, and within the company cash of 360,000. The business is currently owned, this construction business, by a husband and wife. He's 64, she's 63, she's taken nothing to do with the business. And the husband, he himself inherited the business from his parents on the second death at age 26. Basically, they live in a nice house you can see in Northern Ireland, let's say, 1.2 million debt free. And they have two holiday homes that are going well, one in Scotland, 400,000 debt free, and one in Donegal, 700,000 euros, 600,000 pounds debt free. They also have personal cash of 140,000 ISIS shares at 220. Believe it or not, the old thing, they have 4 UK buy-to-let houses, maybe not very good, smart inheritance tax planning, but they have them, and there's the value of them. They have term life and policies of £1 million on first death. They have private pensions, you can see there, the husband 620, the wife 27. Wait for them, this is important, they have 5 children. Son, he's aged 30, he's married with 2 kids. He left school, went into the business at 18. He's now the operations manager, living near his parents, and the parents provided him a 50,000 deposit for his new house. Daughter aged 29, she's single, she's a chartered accountant, she's working in Australia. Son aged 27, he's married with 1 child, unfortunately special needs, has returned home with his wife, having lived in the USA for 3 years, started working in the business, and the parents have also provided him a £50,000 deposit for the house. He did actually a business degree at university. Daughter aged 23, single, recently qualified doctor, would like to travel for a few years, work abroad. And finally, the son aged 19, number 5, he's studying law at university. Now, there you go, left-hand side, that's that statement of affairs. Note the significance, it's putting in the business and the personal assets, and that's key to the next stage to how to get a fair distribution. Also note that son A, really, it's accepted now that he didn't get paid the true salary, and that he worked long hours, and actually he contributed much to the current value of the business. So played around with a fair bit and decided that he contributed £400,000 to the value of the business, which he didn't get. So we're now saying he should get that 400,000 for any distribution to the rest of the family. So we take 400,000 off mum and dad's net assets. Okay. We're similarly saying that son A and son C, mum and dad gave them 50,000 each for their houses when they got married. We're saying, to be fair to the other 3 children, they're equally entitled to 50,000 set aside for them for houses in the future to ensure equal treatment. Again, that comes off before any distribution to the rest of the family. And finally, son E, remember, he's at university, and we're saying is the rest of them all go to university paid for, and we should provide 30,000 the rest of his university costs. And again, that should be taken out before any distribution to the rest of the family is worked out. And finally, mum and dad have decided we'd like to ring fence £200,000 for the special needs child. That's okay, that's the children. Then a wee bit of smart tax planning. Mum and dad have also decided that business premises, you remember, that were worth 800,000. They've decided that they're actually going, they can work through a SaaS situation. They may require a little bit of help from an EPUB, but based on these figures, they don't. And they're going to actually sell, the company is going to sell the property that the company is using to a SaaS, of which the mother and father are the owners of, beneficiaries of. And believe it or not, that SaaS is going to rent the property to the company. The company is going to get tax relief on the rental payments, and mummy and daddy are very tax efficient for them, and the pension doesn't pay any tax on the rent received. Now, if you think about it, what that does is this is the table. This is complex. This is probably after 3 to 4 to 5 months of ongoing discussions with mummy and daddy. The reality here is that you can see there very quickly, there is the 400,000 going to the son A before the distribution. There's the 800,000 going to the value of the property out to the SaaS. And then what we're saying here is that one of the children, child A, is getting 60% of the business. And it's the business net of what we talked about there, net of the property and net of the 400,000 to son A. And you can see son B is getting 40%, which is 560,000 the business. Now look for it. Basically, you can see the buy-to-let properties, 3 of them are going to go to daughter B. The buy-to-let property H is going to go to son C in addition to the 40% he got in the business. The Donegal holiday home, actually, that's very sentimental. They all love that. That's really a great spot. So it's too early to take a decision on that. So what's going to happen is going to be divided among the 5 kids, but there's going to be a partnership agreement, which is going to cover if, say, 4 of them decide to sell, it has to be sold. But equally, there's ways where they can, if somebody wants to leave, they can be bought out. And you can see the needs for the special child, etc. The outcome of all this is, look, please. The outcome of all this is that at the end, look at the bottom, son A, B, C, D, and E, they're all treated exactly the same. They finish up with £970,000. at a particular point in time on a day, a fair and equal distribution if they agree to it. Now, what that really means is you've also, there's assumptions, the first 220,000 cash at the end will be distributed equally among the 5 children. The truth is, if there wasn't cash at the end and you put in the raise a mortgage on one of the houses to at least 220,000 to be spread among the others, we've also put in this case, that son A is immediately transferred 7% shares and son C 5% of the company. That's to get the smart tax planning. We've also highlighted the partnership agreements that will be required on both the principal private residence, because being left, if you check there, the principal private residence is being left potentially between 2 children, daughter D and son E. So again, you handle that with a partnership agreement, how that's going to be handled and sold at some stage post-second death. And there's major tax planning involved. So what I want you to do here is, we've done it. That's how you do it. And it can be done. Let anybody tell you it can't be done. It can be done. Just needs careful thought. Now, in terms of wealth, we highlight this slide because it's too big a topic to go into wealth management today. However, if you think about it, on the left-hand side, in our experience, are the 4 factors that can grow your wealth: business success, inheriting gifts or inheritance, increasing asset values, or windfalls. And tragically, that big ball can reduce to a very small ball very quick, because your wealth can be reduced by business failure. That's back to looking after the business as opposed to getting the right family members or wrong family members running it. Gifts to other people, decreasing asset values, or adverse cash calls, maybe a big super wedding somewhere off in the Bahamas or somewhere. But the bottom line is, in between are the wealth management techniques, and I'm not going to go into those today, but they are there. And certainly our colleagues at AIB Wealth will be very keen to have an opportunity to informally, confidentially talk to anybody who would like to discuss those issues. So, what are the things you need to address in conclusion? Number 1, again, please start the planning process early. Pause, step outside your comfort zone, work on balancing the business and family needs, de-risk and maximize family wealth to a business succession plan. Avail of outside help, a succession facilitator. Treat all children fairly. Massive word. Massive, massive word from both a family and a business perspective. Focus on transparency, providing clarity and removing any uncertainty. The famous meeting with the family, any question, that's it, it's plain and short. We regularly amend the agreement during the course of the meeting. But what you've got to make sure here is that if you meet, or in 10 years' time, if Maggie, son A, his wife, or daughter, or one of the daughter's husbands meet down the town and they say, "Oh, we got a very raw deal. Oh, look at that company, that's worth so much. Or look at that company, is how to sell it is worth nothing." The key point is, you can look them in the eye and say, at a point in time on the 15th of March 2024, we sat down as a family and we agreed at that moment in time this was a fair and equal distribution, and more importantly, that thereafter what each of us did with our own assets or money we gained was our own business, but that at a point in time it was totally fair, and therefore you can go to your grave happy. You can meet anybody in the face and you can tell them everybody signed up to this agreement, their own free will, they were very happy, and go and talk to your husband or your wife and they'll let you know they were very happy with this agreement. So that's why you develop a written succession plan, the family agreement. It's not a legal document, but it does facilitate the preparation of other documents such as the shareholders agreement, the partnership agreements, director service contracts, etc., etc. So, what are the factors most likely to cause you problems? Well, putting off a commitment to commence and ultimately succeed in the family business and personal asset succession process. That is always having something else to do. Too busy. Too busy. Busy food. Please do not fudge this decision. It's the most important decision you'll make from a family wealth perspective. Emotion blurring objectivity, especially with business and choosing the right people for the right roles and ensuring that the right ownership structure is in place. Not availing of the opportunity to combine business and personal assets in estate and affairs for senior generation, and combine that with adequate financial security planning for the senior generation. I didn't go into it in an example, but you can see where we put the pension aside, the property into the pension to give cash to parents, and we also didn't use their full resources, if you notice in the distribution, but on the benefit that on death, after that distribution, 220, the first 220 was sorted out, thereafter everything was divided equally among the 5 children. Assuming all children should have an equal shareholding in the family business or some family assets is not key to fairness. The more important thing is that people are happy that in the combined combination of family and personal assets, that the children have all been treated fairly. And avoid discussions, and this is a must, avoid discussions on detailed succession considerations with the next generation until a draft written family agreement has been developed by the senior generation. Then call the meeting. The worst thing you can do is to go and talk directly with the next generation and say, you're getting Y or you're getting Z. You may be sussing out what they might like or talking generally without actually saying, do you want? Because think about it, once that family agreement is presented at the table, and in many cases I've seen changes to it and agreed by the way at the meeting, but once it's presented at the table, to take something, to give somebody X, you have to take it off Y, because the entire family's assets, it's a very open, transparent thing, including life policies, are on the table. So it was Dr. Martin Luther King who said, the ultimate measure of a man or woman is not where he or she stands in moments of comfort and convenience, but where he or she stands at times of challenge and controversy. I think it was Drucker who said, the key assessment of a chief executive is how they pass on the business to their successor. So finally, to quote Martin Luther King again, and all our leaders are in Washington this week, the time is always right to do what is right. Mark, more than willing to take questions.
Feargal, that's fantastic. Thank you so much. Covered a lot of ground in there, as I would expect, and it's always fantastic to see it set out in examples and trying to make it true and real. So yes, if anybody has any questions, please do make use of the Q&A. Those are anonymous questions, so feel free to throw anything in there whilst people are maybe getting their thoughts together. A couple of thoughts in my mind. Is there such a thing as a typical family agreement? If there is, what sort of timescales are we talking about, Feargal, do you believe, from first engagement?
There's a broad one which I give an example of in terms of you can't start off from a pro forma one, right? But the truth is, I would say on average, and this, funny enough, quite often the larger companies are easier than the smaller companies, you don't know the truth, but on average, about 4 months. 4 months from the start of the discussion. We use it and call it the family agreement. The family agreement evolves as a discussion document between the succession facilitator and the senior generation, if you get me. So what happens is, the first part is quite easy. You get the statement of affairs and all, but then whenever you start to allocate, why should so-and-so be doing this, or why should you, and you may want to even go on to the next stage and say who's going to be the managing partner or the managing director. You can do all that in the family agreement. It doesn't have a legal effect, but what it does do is, when that's stated in the family agreement and there's actions, the actions would then say, follow up if it's all agreed with a solicitor to do a shareholders agreement which reflects these responsibilities and directors' contracts. Do you get me? So the family agreement, whilst not being a legal document, is actually the key document because it sets the framework for everything. So 4 months about. The shortest one I ever did was, believe it or not, 6 weeks. So it's not a short process. And the longest one I did was 2 years.
Okay, useful to know. Just a thought. I mean, every member of every family is not going to be in agreement with the approach. Any suggestions as to how to deal with that more difficult character in the family?
Yeah. The senior generation is key in this. You're really relying on them to try and suss out what people's concerns or what they aren't. And believe it or not, when you go to present the family agreement, make no mistake about it, if I go into that room and you heard like the wee small things there, you notice with the 50,000 given to 2 kids already for their houses, if that's not disclosed, see, once you go into that meeting, well, what about him? He got 50 grand or he got 100 grand. You get me? So it's really important you be unbelievably transparent. The truth is, Mark, when you go into the family agreement, you do believe you're going to get agreement. And the reason you do believe you're going to get agreement is you have flushed out in that document virtually all the things. So if you think, for example, somebody loves a particular house that you might have a buy-to-let or something, you put that in. Obviously, one of the other things is in terms of buy-to-let from inheritance tax planning, and I didn't cover it. Once you've taken a family agreement and it's agreed in principle, it may well be that those are the type of things you move early because you want the senior generation to live 7 years. Or they're going to cover her. But again, the family agreement is key. So I would argue I have never gone into a family agreement without the belief of that meeting, the family agreement meeting, that I'm going to get everyone. Like I've done one with 9 children. It's actually one of the first ones I ever did. Mommy and daddy are now dead now. 8 of the children were in the business. 8 in the business. 1 not in the business. 3 of the family members who were in the business are no longer in it for various reasons. That family agreement, 20 plus years, has stood the test of time. Yeah. That's a very interesting one. But the point I make is, Mark, you go in with the intention. I firmly believe, and this maybe is tough, I firmly believe if we leave the room that night or the next morning before the family agreement is signed, it won't be signed. Yes. There's no taking it away to think about it. People have got to be very happy. They're not being forced to sign it, but they have to be very happy at that moment in time that it's a fair. So that's where the openness really, you got to say everything mommy and daddy have done. They've got to be. Now, the smart thing then is, and I didn't cover the presentation, the smart thing then is the truth is told, that you leave mommy and daddy, if they're still living, or the senior generation, wherever they are, enough cash when they're living to have a lot of discretion. So, for example, if one of the children or the daughters are very good and they go on holidays with them every year, none of the others need to know that mommy and daddy paid for that holiday. None of the others need to know that mommy and daddy have given them a bit extra money after the family agreement, because it's mommy and daddy's proud to do they like with their cash, so long as they honor the family agreement. You get me? So, and as we all know, when you die, then your statement for your bank is frozen, and all that's known is your bank balance at the date of death. What you did before that. So those are the practicalities of that.
Super. We have a very salient question here. With couples maybe deciding to have children later in life, it can be difficult to map out an agreement when your children are still quite young, but you're approaching retirement age. Have you come across a scenario like that where it's difficult to envisage children's role in the business?
It's a very smart question, by the way. There are 2 issues there. Number 1 is the issue where you have young children and you have older children. So literally you may have somebody at 14 or 15 or 12 or 13 still at school or whatever, and you have somebody else maybe 25 or 30 running the business. And believe it or not, we'll come across that. That quite often needs to be dealt with in an open and transparent way and put something into trust for the younger people if you wish to do it. However, I have seen 16-year-olds at family meetings and actually very happy. Some of the best questions actually I heard raised was actually from a 16-year-old girl one time at a key meeting. The next one is more tricky. If they're very young, Mark, the only way to do that, to be honest with you, is some form of trust or to cover in the family agreement what your plans are. Because the problem here is you got to be honest. Unless, and this is the golden rule, it's in one of the slides, and I don't think I highlighted, you must pay family members every year for what they do. You cannot afford Johnny's wife stopping you down the street 10 years later and saying, "My John, he worked there whenever that little child wasn't even born. He worked there for the last 20 years, and that little child went to university and swerved all around the world." You've got to say to her, that really, he did, you're Johnny, but your Johnny was adequately paid and rewarded for everything he did every year. And that's why I keep saying you've got to plan early for succession. If you haven't done that, you need to start addressing that quick, because that's actually one of the biggest gripes that arises at family meetings. So to answer the specific question, you can do it, you need to do it, because the truth is your financial independence is important, but it's just in the case of the special needs child, as you've seen in that example, the grandchild. We ring-fenced a certain amount of money. Again, you can do that, or actually you can put shares in trust, or you can say people will look after them. One of the other things I've seen do, which you didn't do that example, because it's so hard to give an example quickly to give the picture, but I have seen in some cases, which is interesting, where a number of family members who aren't in the business have got very small shareholdings. But what it has done is it has kept the people who are in the business truthful. Because say if there's two people working in the business of equal shareholding, they've made the specified decision model just above one of those two, which basically means they have to convince two or three of the other family members whose shareholding might only be 5%. Do you get me? It's a very useful technique to protect family wealth. And also it means if you ever sell the business in the long term, even 10, 15 years later, somebody with 5% benefits greatly from it if that happens. And that's a way I've seen some young children also dealt with it. The shares were put in trust.
Super. We have another really important question here, a very, very common scenario, I imagine, where the founders of the business are actually siblings, and you therefore have maybe two families or maybe more than two families to take into account. And again, any particular advice there as to how you manage?
Yeah, a very common one, straightforward. This is an easy one to deal with. This basically requires a shareholder agreement or a partner's agreement from day one. And basically, in my honest view, and this is not going to be popular, I suspect, with some of the people in the call, in my honest view, if you remember the share transfer thing I talked about and the valuation of shares, in my belief, the first option on shares is the company to purchase the shares. So what that means is, wait for it, if you have two brothers, Billy and Sam, Billy or Sam cannot pass the shares on to their son or daughter without the other person agreeing. Because the first option is for the company to buy the shares. Very significant. It's the only way to resolve it, because otherwise, at different times, you'll have different perceptions who should get it or who shouldn't get it. So I have seen it very successfully by the way resolved, but it's been resolved because it was a good shareholders agreement in the first place, or partnership agreement, and then there was a framework that I'm saying that if the other person believed they were the right person to bring in, then you could do it. But technically speaking, you weren't forced that overnight your brother's children or your sister's children could be in at the boardroom table. And it's a really, really important point. It's back to running the business, making sure the business runs right, as opposed to who's running it. It's a really massive point. I must say, a fantastic question, but it's one that needs dealt with nipped in the bud immediately. That it's even beyond succession. That's a very dangerous position. My experience, if there's a shareholders agreement in place, it keeps everybody honest. They know the rules of the game. That doesn't say that one family won't take over the business. No problem. They sit down and they say, but what it does do is people know the rules and what they have to do.
And a supplementary question to that, you've obviously sparked some thought. Would this be the same scenario if there are equal shareholdings that are not family related?
Yeah, and the reason for that is it's back to the same point. That's why I believe you do away with accountants and lawyers. You create a shareholders agreement or a partners agreement, which defines how the then auditor or accountant, whoever it is at the time, they define the value, nobody else. And you're either a good leaver or a bad leaver. And then the option is the company, the first option, could well decide not to exercise it. Then the existing shareholders, pro rata, may decide not to exercise it. Then what could happen is they both agree to the deal and they smell at each other and they allow the other shareholder to buy it. But you get the point I'm making? Legally, they have to convince the other person. They can't walk down the street into a coffee shop without the other person knowing to hand over the shares.
Very clear. Very clear.
No business should operate if it's a company or a partnership without a partnership agreement or a shareholders agreement. And I stress that in our own practice, if we have any client we take on after 2 years and haven't done that, if I get my way, we resign.
Very good. Very
There's
good.
a lot of trouble down there.
I'm just checking my screen. I think we have one more question. Is a family agreement, whilst not legally binding, recognized as a dispute resolution by court?
I'd be upfront and say it is not a legal document. So it depends on the situation of the resolution. But the truth is, it's not a legal document. And don't misinterpret the word trust here in terms of legality, but it's a trust document among blood relations. Suffice to say that I've actually been at the reading, I've been an executor to a will, that when the will was read out, it didn't reflect the family agreement. And the person who was going to benefit from the will most jumped in immediately and said, I'm not happy with this. I want this to, data variation to go in immediately. I want this to reflect the family agreement. But other than that, and I've done well over 100, I've seen fathers and children and mothers fall out. I've seen them not speaking for 10 years. But when the will came out, it respected the family agreement. And in my experience, blood is even better than legal. But you have to accept that a will, an individual always has the right to change their will until death. Otherwise, you wouldn't benefit from the various tax reliefs. But what this does is you have to trust. And it's a massive tax benefit if the children, the practicalities here, let's say a business of 4 children or 3 children are all working in the business, or 3 of them's working in the business is worth 5-10 million, say. And to be honest with you, they're now running the business. Mommy and daddy really want to do the business, right? But the benefit, if you can get the trust that they're only a small shareholder. Think about this now. I could give you numerous examples of this, where actually there's been a tragically a divorce or a split up or anything else, right? And the wife or the husband, the spouse of the person in the company thinks, oh, I'm worth some money. They suddenly realize they're not. That whilst on second death, their Johnny may be getting 30% of the company or 50, they currently only own 5%. And that's why the family agreement is fundamental, but it's back to trust. You have to work day and night and say to your spouse, look, I'm taking over this company when the second death, but I don't legally own it.
Super. I have no more questions there, Feargal, but it's quite clear we sparked a lot of conversations. So as we said at the start, this has been recorded. We will share this shortly afterwards, and you're happy for the slides to be distributed.
Yeah, no,
and obviously
each time the slides are going, but we don't have a problem.
That's super.
But to be fair, by the nature of the presentation, I had an option to leave the case studies out or put them in, but by putting them in, I had to run very quick at them. But the truth is that if one has time to study the slides, I think they'll understand the family agreement concept, and I think they'll understand the inheritance tax and the capital gains tax. But the key point here is that you can treat children fairly by combining both the personal and business assets, do a desktop evaluation, and be upfront of it and say, give or take, this is where we are now.
Fantastic. Feargal, thank you so much for your time today. I know that's been really useful. Thank you to everybody who's joined us on the webinar. We have other FPM webinars coming up after Easter, things like R&D tax credits and restructuring. So as always, lots of fantastic advice from our patrons FPM. We're very grateful for all of your support, and we hope I really find that useful. Thank you very much for joining us this afternoon.
Thank you very much, Mark, and thanks to everyone who on the Friday of St. Patrick's again decided to go into a business succession. So thank you very much.